Hi everyone, welcome back to the Commercial Real Estate Library. I'm Dama Tamanawala. In real estate and in life, there's three ways to have more money. The first is to make more money, second is to save more money, and the third is to have an absolute weapon of an accountant to help you save on taxes. And with us today, I'm joined by Brandon Hodge, partner at MNP. Brandon, thanks for being here.
Thank you very much.
Before we get into everything, so Brandon is essentially, he has extreme experience. MNP is the largest, one of the largest tax and accounting and consulting firms in Canada. Let's talk about how your career got started.
Okay.
So first things first, how did you kind of get into the industry? How did you get started?
So I'm a lawyer by training, and my background was that of a Bay Street corporate lawyer.
Right.
My first week of articling was in September of 2011, and the September 11th attacks really is what had one of the more profound impacts on my career and certainly the economy at the time.
Right.
Where in a real estate context, the law firm that I was at was heavily oriented towards transactions and deals. And one of the first jobs I had was considering whether or not a force majeure clause or act of war clause that would typically be involved in a corporate acquisition or real estate transaction, whether those were included in any of the contracts that we had just had, to see whether or not we could get out of them, because real estate, there was a certain degree of uncertainty whether downtown real estate would still have value. So that was a starting point of my career in real estate.
Okay.
From then, I went to...
Sorry, how does that clause work, Brandon? So
a force majeure clause, or major force clause, is essentially a way to get out of a contract. The force majeure clause says that if there's an act of God, act of war, storm,
right.
Market closure, if the stock exchange is suspended for whatever reason, then the contract is null and void.
Right.
Essentially, the underlying fundamental economics of the deal have changed so much that both parties just want to walk away.
Right.
And in real estate, back in 2001, we didn't know what the current market was going to be, whether it was going to stay strong, whether or not companies were going to leave downtown, whether or not real estate as far as an investment was still a viable going concern.
Right.
I think the last 17 years have answered that question quite conclusively. And from that point, my career shifted. I ended up at an accounting firm, one of the big four accounting firms, where we were doing a tremendous amount of work in income trusts, and in particular REITs, real estate investment trusts.
Yeah.
That was all driven by tax. And the reason being is that the way the tax system was set up, there was a certain degree of double tax that shareholders were paying when they received distributions. An income trust or a REIT was a tax-effective and efficient way to operate the business to reduce the incidence of double tax. So that was the background to my involvement in real estate, was really based on tax-motivated or tax-focused structurings of how to hold the investments.
Okay. So what excited you about the industry? Like, why specifically? I guess you deal with a lot of wealthy families and real estate owners. What specifically got you interested?
The reason I chose tax was because tax is essentially the architect. If I was asking someone why we're doing something, the answer invariably came back to there's tax reasons.
Right.
So I wanted to be the person who was involved in the decision making as opposed to just doing the work.
Yeah.
So when we look at the way things are structured, the way transactions are structured, the way holdings are structured, if you want an explanation of why the way things are the way they are, it's typically a tax answer, right, as opposed to a business answer or a legal answer.
Right. What are your responsibilities in your current role?
So I'm a partner in the specialty tax group at MNP. MNP is the 5th largest accounting firm by revenue in Canada.
Right.
The difference between MNP and your traditional Big Four accounting firms is we tend to focus on private companies, what is often referred to as the mid-market. As a result, our focus is more on entrepreneurs, on wealthy families, on business owners, as opposed to chasing bank audits, public company work.
Got it.
We do some of that work, but our main focus is on an owner-managed economy.
Okay.
My role at MNP is that of someone who would be involved when you are looking at restructuring your business, selling your business, or if you have some sort of controversy issue with the CRA. I'm also the co-head of the tax controversy practice for Canada.
Okay.
So we see a lot more controversy work in the real estate context, particularly in the last 2 years. We'll talk about that a little bit more. But my role is not from the compliance perspective, it's from the planning and structuring side.
Right. If you have a business that you want to sell,
Yep.
what is the best way to make sure that you're not giving Justin Trudeau everything that you have?
It is tax motivated.
Right.
Often clients will speak to us not for the purpose of making sure that they are in the best situation, but that they are not paying more than absolutely necessary.
Got it.
There's a certain degree of tax checkup we often will do just to make sure that the structure that's in place is still effective and efficient based on the rules as they are today. Changes might have occurred in the last several years. Clients often just want to make sure that what they're doing today still works from when they originally put the structure in place.
Got it. What trends are you seeing in tax planning?
The biggest trend that we're seeing in tax planning is that what we would have traditionally done, we can't do anymore.
Okay.
So the traditional structure would be a parent company that owns an operating company that might have real estate.
Right.
That real estate would generate cash flow, and the cash flow would be paid up to the parent corporation for asset protection purposes. We can no longer pay up that cash as a tax-free intercorporate dividend for asset protection due to the new safe income rules. As well, the shareholders who we would typically see of the parent corporation would include family members who might not be active in the business. This could include minor children, parents, spouses, family trusts. The typical planning would have been to pay dividends to non-active family members who were in a lower tax bracket.
Right.
Effective July 2017, the new tax on split income, or TOSI rules, now apply to dividends that are received from private companies, and there's restrictions on the amount or quantum of dividend that an individual can receive. Traditionally, the restriction on paying family members from a business was salaries. The salaries had to be reasonable. There was no reasonableness standard that was imposed on the payment of dividends. The new tax on split income rules are trying to effectively impose a reasonableness standard on the payment of dividends.
Right.
Where dividends are considered to be unreasonable, they're going to be taxed at the top marginal rate.
So this is, as an example, you're paying your wife a salary of $100,000 because she's in a lower bracket than you are personally.
Yep.
Or your kid who's about to go to university.
Yep.
Now someone is going to come in and say, okay, well, what was your son actually doing?
Yes.
Okay.
Now, this has been really the last year and a half, 2 years, that we're seeing this huge sort of sea change in the traditional planning. I will say that this is being driven primarily as a result of political considerations.
Yeah.
Whether or not there is a political resolution that will deal with this issue, certainly the government has changed their policy on a couple of their proposed solutions. We do not know whether or not there will be additional changes or whether the government is going to go through with the tax on split income rules as they're currently drafted.
Right.
But this is something that is affecting certainly MNP's clients who are in the private owner space. But it affects every real estate investor, every person who is looking at doing estate planning or family planning to either distribute income to family members or to minimize their taxes on death.
Okay. Can you tell us a little bit about provincial tax arbitrage?
Yes. So there's two main tax strategies that we look at. One is deferral, one is tax savings.
Right.
For deferral strategies, on a long enough timeline, a deferral becomes an ultimate tax savings. If you can push a tax liability off by 50 years, the taxes effectively are nullified.
Right.
With provincial tax arbitrage, we're looking at tax savings. That is, we are looking at having income that would otherwise be taxed at a higher income rate or tax rate, be taxed at a lower tax rate. And really, the plan is to shift income, traditionally in the form of dividends, from a high tax jurisdiction, in this case Ontario,
Yeah.
to a low tax jurisdiction, which might be Alberta or Saskatchewan.
Okay.
The typical way that this is done is through use of a trust. So a trust is taxed as an individual, and it's taxed in the jurisdiction where it's resident. So it's very easy for a taxpayer to move the residency of the trust to a jurisdiction different from where they live. The trust was generally going to be resident where its mind and management is located.
Okay.
And in the early part of this decade, the Supreme Court of Canada, in a decision, came out and said that mind and management for trust residency is where the trustees make their decisions.
Okay.
So there are a couple of ways to shift residence of a trust to another provincial jurisdiction. One way is to hire a third-party trustee to act as the trustee in that low tax jurisdiction.
Right.
The other way is to physically be in that other provincial jurisdiction when the trustees' decisions are being made.
Hop on a flight to the Northwest Territories and make your decisions there?
That's simplified, yes.
Okay.
We generally want there to be some sort of nexus to the province, but as long as the decision-making for that trust is being made in the province, there is a reasonable filing position that the residency of that trust, pursuant to the Supreme Court of Canada's directions with respect to mind and management, is in that province.
Okay, and just to be, just as an example, if you sold a $10 million building, for instance, in Ontario, versus if you had the mind and management and the resident of your trust was in Alberta, what kind of difference would you see?
The main difference is in the tax rates on eligible dividends.
Okay.
And so for income that was taxed at the top marginal rate that's coming out as eligible dividends, the discrepancy, the tax arbitrage between Ontario and Alberta and Saskatchewan is around 8%. As short as 5 years ago, it was almost 15%.
Okay.
The tax rate in Alberta on eligible dividends was less than 20%. Ontario, the tax rate was just a bit more than 33%. The tax rate on eligible dividends in Ontario today is almost 40%. So we've seen a huge increase in the dividend tax rates on eligible and non-eligible dividends. And as provincial jurisdictions have changed governments and those tax rates have gone up, we've seen a narrowing of the tax arbitrage between Ontario and, let's say, Alberta.
Okay.
However, if you are in a position where you are going to be paying dividends, in particular eligible dividends, over a period of time, that 8% tax arbitrage can add up over a cumulative effect.
Yeah.
The advantage is that it is a hard and fast tax savings, as opposed to simply a tax deferral.
Right.
Now, if you need that money for consumption, provincial tax arbitrage is a great vehicle to do that. If, on the other hand, you do not need the funds for consumption, we would look instead at a deferral strategy.
Okay.
Avoid paying taxes until you absolutely need those funds.
Right. And I guess we can hop right into it then. Can you tell us about the difference between a Canadian-controlled private corporation and non CCPC, non-Canadian controlled private corporation?
So the income tax system in Canada with respect to small businesses and private corporations is intended to provide a host of essentially positive tax planning or tax results for what are considered Canadian-controlled private corporations.
Okay.
The tax advantages include access to the small business deduction,
Right.
which is a lower rate of tax on the first $500,000 of income, of active business income earned
Right.
by the business. CCPCs also enjoy preferential tax treatment on stock options.
Okay.
They have access to scientific research and experimental development tax credits, which is if your company is involved in developing any new processes or other sorts of technological advancements, you can get refundable tax credits which aren't otherwise available to public companies or non-CCPCs.
Okay.
With all of those tax advantages, however, are certain tax drawbacks. So you're relatively neutral between earning investment income personally or earning investment income through a Canadian-controlled private corporation.
Right.
There are ways to avoid that tax or income from investments being taxed at that refundable tax rate. The first way is to convert what would otherwise be passive income into active business income. You
Okay.
can do that by having more than 5 full-time employees in your corporation.
So if you're currently contracting out your cleaning staff or something for an apartment building that you run, you might want to just take that on and that can reduce your tax rate.
Absolutely. The general guideline is that if you've got more than 5 full-time employees, it's not a passive business. You're now operating an active business and you should be taxed as such.
Okay.
The other way to get out of the refundable tax system is to simply not use a Canadian-controlled private corporation as your investment vehicle. You could instead use a non-Canadian company, and this could be a company that's incorporated in a foreign jurisdiction like the United States or another country. You always have to be conscious about being in the tax net of another jurisdiction, but there are favorable jurisdictions where the compliance burden, the tax burden is relatively limited.
Right.
The advantage from a Canadian tax perspective is that any income on rental or interest income, foreign dividends, royalties that are earned are only going to be taxed at a 26.5% tax rate for Ontario,
Yeah.
as opposed to a 50% tax rate on if you were in a CCPC paying tax on the refundable tax regime. So you've got around a 23% difference in tax deferral
Yeah.
for rental income or interest income, royalty income, foreign dividends earned by a non-CCPC.
Okay, so that's huge to have that delta being deferred, and especially over years and years and years. But I think a lot of people are uncomfortable with that idea, or maybe they don't think about it, or it's just they think, no, I'm a Canadian citizen, I got to do things the regular way, or else I should feel guilty. Can we talk about some of the organizations that do this, or like how common it is maybe?
It really depends on what the ultimate goal is. If there's a sale of a building and the purpose is simply to reinvest in additional real estate, then we see families relying on the replacement property rules to essentially roll over and defer that tax liability until the sale of the next
final
property.
Yeah.
We're seeing more and more of non-CCPC planning. Certainly it's something that from a deferral standpoint is very attractive. It's planning that has been around for a long time, and it's planning that is, I would say, well known.
Yeah.
However, a lot of the issues that we deal with are effective implementation.
What major technological advancements have been made in the industry and are being made in the industry of tax going forward?
We've seen a huge change in technology. When I started my career, everything was still predominantly paper-based. Now it's all electronic. The advantage of that is I have access to judgments, CRA commentary, cases, resources, all in my laptop. I can
Right.
work remotely, and research that used to take me an entire day if I was doing it through paper method, I can now do it in half an hour, which is a tremendous benefit to a tax practitioner because you've got access to resources.
Right.
You're not limited only to the tax library that might be in your local jurisdiction. However, the CRA has been just as busy on developing their technological resources. Specifically, the CRA, a couple of years ago, received over $600 million increase to its budget. The promise the CRA made was that they would collect $5 for every $1 invested. Where they've spent a tremendous amount of that budget influx is on technology.
Right.
The computer systems that we see the CRA using both for filing online tax returns as well as the computer algorithms they're using for audit purposes has completely changed the scope and face of tax audits in Canada. And this has been a profound difference in the last 2 or 3 years. No longer can taxpayers think that they can just hide being one in the crowd. The CRA is now focusing very effectively on tax planning that they think is either untoward or substantial, there's substantial risk of implementation being done appropriately. We're seeing this in particular where people are claiming the capital gains exemption through a family trust.
Right.
Implementation there is very poor, and the CRA has had great success in challenging those.
This is already happening.
This is happening today, and this is going to happen tomorrow, and this is the new face of CRA audits. Expect targeted audits that are designed with specific transactions or investments in mind. Look at CRA going after particular industries, and all of this is being driven
Real
by
estate, for example.
real estate is a big one, pharmaceutical is a big one,
Right.
cross-border transactions. The biggest change that we've seen with the CRA has been in their voluntary disclosure program. Traditionally, the voluntary disclosure program allowed a taxpayer who had unreported income, potentially from offshore sources, to voluntarily go to the Canada Revenue Agency and say, I've got undeclared income, I want to come forward, and they would get relief from penalties and some interest relief. They would have to pay the taxes on that unreported income, but essentially they were allowed to come in out of the cold.
Right.
Effective 2018, the CRA has reduced the ability of individuals to come in and to declare offshore undisclosed income. The reason for this is because the CRA believes that through their technology, through the information sharing agreements they have with other jurisdictions, that they will catch people who have offshore undeclared income.
So it doesn't matter if people are coming forward or not, they're going to be found.
They're going to be found. They no longer have to rely on people to come forward voluntarily. And this is driven entirely by the CRA's investment in new technology.
Right. I know a lot of real estate practitioners probably watching this right now are they're getting a little bit nervous. But that's okay because you can call Brandon.
Well, we see reports going out. Most recently, the CRA is working with FINTRAC, where any transfer of $10,000 to or from Canada, if you have received that or your business has received that, expect to get a letter from the Canada Revenue Agency saying, are you aware that all offshore income has to be reported?
Right.
This is not a threat. This is not the CRA saying that, you know, we think that you have unreported income. It's just an example of the sort of information sharing that the CRA has with other groups, whether it's FINTRAC, whether it's the new CRS, the Common Reporting Standard obligations that all countries, other than the United States, are expected to be able to provide. The days of essentially doing your taxes and thinking that you can come forward under the voluntary disclosure program in the future, those days are over. We're seeing a very different perspective from the Canada Revenue Agency with respect to audit activity. It is much more targeted, it is much more focused, and the sorts of things that the CRA is looking at are much more sophisticated. So auditors have been trained, new resources have been set out, but the greatest change and asset the CRA has is their ability to do data mining and look at taxpayers based on filings, based on information provided from foreign jurisdictions. It's a new audit framework, and it's going to be something that taxpayers are going to have to appreciate and understand.
I'm not excited about that. We as brokers get emails from FINTRAC all day long.
Yep.
So I'm very familiar with that. Okay, this is kind of a similar question,
yep.
But what can we expect in the next 5 years in terms of major change or what have you?
The next 5 years, I think, are going to be driven by political risk. The last 3 years have been driven by political risk.
Right.
Where a lot of the changes that were implemented with respect to the tax on split income, with respect to capital gain stripping, with respect to investment income that was earned in a Canadian-controlled private corporation, are all being driven for political purposes.
Right.
We've got an election coming up, and we also have to deal with the tax reform that's going on in the United States. Right now, Canada has said that our tax policy is going to be independent of whatever the United States does.
Okay.
However, if you've got two competing jurisdictions in which one is high tax and one is low tax,
Yeah.
it's very clear which jurisdiction is going to have an advantage in attracting capital. The tax landscape over the next 5 years, which will take us to, let's say, 2024, end of the next presidential cycle,
Yeah.
is going to be driven entirely by politics. What those politics are going to look like, we don't know. But certainly NAFTA, and whether or not NAFTA is still around, is going to be impacted. We're also going to be looking at issues with respect to corporate versus personal tax rates.
Yeah.
Historically, personal tax rates have been going up in Canada, corporate tax rates have been going down. That's positive for business investment, negative for people who are resident in Canada and paying taxes.
Right.
So there's a lot of change. Include on that the baby boomers starting to die and the transfer of wealth from the current generation to the next and tax planning associated with that. It's going to be very, very busy.
Okay. Okay, so we are going to include your email address, brandon.hodge at
Yep.
mnp.ca, in the show notes, as well as, is there anything that people should be paying attention right now that you guys are putting out, or?
We've got on our website notices or tax bulletins with respect to tax changes. Those are geared typically to industries, whether it's real estate, agricultural,
Yeah.
Pharmaceutical, manufacturing, technology. Our website is a great resource, and you can include that in the notes as well. Generally, what we see with respect to the changes in the tax rates and the tax structuring is all geared towards private companies. Public companies have pretty much gone unscathed through the recent tax changes. So it's owner-managers, it's people like your clients, high net worth families who have substantial real estate holdings. Those are the people that are being impacted by these new rules. And they need to look at whether or not their existing structures still make sense, whether or not what they're doing is complete and correct from a compliance standpoint, because they can't expect an audit in the near future based on the CRA's ability to data mine and review tax returns for pretty much essentially a strict standard of compliance, of correctness, and completeness.
Okay. This last question is called the three truths. It's years from now, if you accomplished everything you wanted to accomplish, and your whole family's there, and there's hundreds and hundreds of your grandchildren running around, hundreds. But you accomplished everything you wanted to accomplish. But for some reason, everything that you've put out has been erased. And you can only write down 3 quick notes to pass along to your kids and just people in general with respect to tax. What would those 3 notes be?
Stay interested. This is not an easy profession, and there's a lot of change. In order to stay up to speed, you need to like what you do.
Yeah.
Second, get used to learning, because this is one of those few careers that you are constantly in what I call exam mode. There's never a day where you're not going to learn something new. So and tax in general changes a lot. You need to get comfortable with that change, and you need to be able to change with it. And the third would be accept that you're always going to have more work than you can handle.
All the time.
That was the advice that I was given when I started my career. And I didn't believe it at the time,
right.
And I believe it now, and so I'll pass that along. If you are involved in tax, you will always have more work than you can handle. And it's like drinking the ocean, just one sip at a time.
Okay, that's really good advice. Okay, so I think that brings us to the conclusion. I want to thank everybody for watching and following along. As I mentioned, we will have Brandon's information linked in the show notes, and as well, if you'd like to follow along on MNP's tax bulletin board, where they put out all sorts of great information, we'll have that link there as well. Brandon, thank you so much for being here.
My pleasure, thank you.
Great.